Now let's continue. I'm going to show you one of the ways to find potentially the best dividend stocks. This is something I fully stand behind, and it's a secret that I'm going to share with you. So how do you find great dividend stocks? I can assure you I've been doing analyses for dividend stocks within our community for several years now. Happy investors. We have also grown significantly now with over 860 members. Our team has actually expanded as well. Now we have a team of 5 people. Really great, all of it, of course. And from all those years of doing analyses, you learn a lot. My name is Jorik Vermeulen. I am the founder of Happy Investors. I've been investing myself for over 10 years, and I've been focusing more and more on dividends. But as I will explain in the video, I am indeed a good investor. Why I believe in investing in high quality companies with a superior earning model, and because these companies have a superior earning model and a strong competitive position in the market, they can manage that money better. They enhance their earning models, which gives you a higher return. Then it comes down to a return on investment. Plan for your dividends. Using them for living is fine. Dividend stocks and ETFs are suitable. And if you're doing it to live off of, that's perfectly fine. That's a good choice. So often dividend stocks and dividend ETFs are more applicable for those who are older because they can live partly on dividend income. However, if you're young and you want to invest for the long term, then it's much better to let your returns compound, and definitely let that be managed by very efficient and expert management in one superior earning model, because that's the best way to achieve returns. One way to find good or potentially the best dividend stocks. I'm going to explain that to you now, and I do that based on 10 years of investing experience. And one of the programs that has really helped me achieve higher returns with investing is Seeking Alpha. Well, this is partly promotion and partly not. Why is it partly promotion? Because I mentioned their program and we have our own affiliate link. That's a kind of promotional link where we receive a commission, 20% for every new customer. You can find that promotional link in our YouTube description or in the response. I would appreciate it if you clicked on that. If you want to start using Seeking Alpha, why? Because it has a 7-day status, but you also get a discount of 30 euros. So that's a win-win on both sides. However, I will only promote things if I'm sure it's going to help you, and I've been investing myself for over 4 years now, also based on Seeking Alpha. And thanks to this program, but also another program that I'll show you later, are we really achieving much better successes. So I'm 100% from my heart. The goal of YouTube is to help you, and we share a lot of status content. My name is Jorik Vermeulen. I'm doing this in my own name. My reputation is at stake, and I'm not going to do that for a few bucks. I'm not going to put my reputation on the line for that. I firmly believe in that. Seeking Alpha is one of the better programs that I have found to date, and also for dividend investing, super handy. Why? Their methodology is based on factor analysis. I'm not going to explain everything in this video, but factor analysis takes into account 5 categories: valuation, growth, profitability, momentum, and EPS revision. This last part means that the expectations have been raised that the stock will make more profit than expected. By stock, I of course mean the company. We see in this factor algorithm that momentum carries a very heavy weight within the overall weighting. That goes from 1 to 5. And we see that here, quant rating. If something scores high above 4.5, then it gets a strong buy as a signal. So here we actually see a filtering of dividend stocks, all of which score above 4.5. But if you go to Seeking Alpha and find and compare, you go to stock screeners, then you can screen all sorts of things. And then we go to top quant dividend stocks. And there's another special thing about this, because these stocks have not only been selected, they have an interesting valuation that is relatively cheap or attractively cheap compared to the growth. Do they have good growth prospects? Are they profitable? Yes or no? Do they have strong momentum and an EPS revision? And there are also many pros and cons to it, but that's too complex to explain all at once right now. We're here to find the potential for the best dividends stocks. So you'll still have to do a lot of research yourself. But here we see, for example, Vision Properties. I mentioned it before on our channel. I regularly share stock analyses for inspiration, and there are a lot of winners among them. Well, Vision Properties is also one of those stocks that I've mentioned in many of those videos. If you want to follow our analyses, it would be greatly appreciated if you would subscribe. That helps us a lot. So for what? Super thanks. By the way, I also bought Vision Properties myself. Well, quite coincidentally, it's now at the top of the factor analysis. What does that mean? That means that statistically, it has a relatively high chance of achieving above average returns compared to a lot of other stocks that are in the same data pool. No, same data pool. What's mainly in it? Stocks from the United States. What isn't included? Stocks from, for example, Europe. Let's quickly take a look at Vision Properties. And what you want to do is, for example, look at the valuation. But this is a real estate fund, so then we talk about the price in relation to that. Let's take another stock. For example, Ingredion. Ingredion is currently scoring a bit lower on the factor analysis, but still as a strong buy. How does that work? Let's take a look at the valuation. Then we see that the price to earnings ratio for next year is estimated to be around 12.5. Here we see a sector median. So that means a price difference of 32% cheaper. He now automatically gets an A on the factor analysis because this is a difference of minus 32%. But it can happen that, for example, it says a price to earnings ratio of 20 here, and here it says 25. Yes, then it's still cheaper than the sector median. Just a price to earnings ratio of 20, it can sometimes be on the high side for a company like Ingredion. So you really need to have the experience and skills to look at that very critically. Also very important, for example, is the pain ratio. Well, then you see the valuation. You've done your research as the first screening. This all seems okay. Of course, the next step is to take a look. Is this really a good company to invest in? Because I think a big downside of seeking alpha is mainly focused on the next 6 to 12 months. You should always invest according to the principles of Warren Buffett. Why quant investors are at the forefront of that. That increases the chances of success. So you mainly want to invest in companies that have high quality. One of the ways to find high quality stocks is by always looking at profitability. Here we see, for example, a net income margin of 9%. That 9% is indeed higher than the sector median of 4%. But in this case, Ingredion, just as a random example, is a food production company, and it has no distinguishing features. For example, it's a food production company, and it has no distinguishing features. No sustainable moat. Maybe a small one, but not super strong. Well, and I also happen to know, because I've worked in the same industry, 9% is fairly average for the specific industry that Ingredion is in. So that 9% might be better than the sector median from this data pool, but 9% is really not special. So based on knowledge and expertise, okay, yes, this stock might not be superior, but for example, we see other factors that are quite attractively high at this specific moment. For example, the return on equity and the return on capital. The basic principle in finding the best stocks or dividend stocks is always to invest in high quality companies, preferably the industry leaders, in other words, the best companies in that industry, because that simply increases the chances of success. But let's say you find such a great company and it also scores high on the factor analysis, because the factor analysis mainly focuses on the short term, where the momentum factor carries a heavy weight. Yes, then it could be that you have a winner. Well, you've done a lot of research. You've been patient. You've done your research. I think, okay, interesting. One of the features in seeking alpha is dividends. Here we see an overview of dividend safety, dividend growth, dividend yield, and dividend consistency. We have now filtered for dividend stocks using quant rating. And one of the more important factors in this, the methodology for dividend stocks specifically, is that they also need to score high on dividend grade. And that's why the stocks are filtered in. This specific filtering methodology also pay out high dividends, but especially for the longer term. So there are 4 different factors and they all need to score high in principle. If it doesn't do that, then the company might score high on the factor analysis, but it won't make it onto this list. Then it might come in, I'm just saying, a general list of all stocks. Then we can find, for example, here, can we quickly find a company? Let's take this Grupo Super. As a company, well, it scores very high on the factor analysis, almost a 5. You see, it pays dividends, but we don't find this company in our dividend overview. That's probably because it doesn't pay dividends consistently. How do you see that? For Ingredients, for example, you mainly want to look at the dividend history. What is the dividend policy of this company? For that, you should read the annual reports and you should definitely go through the annual statements. You also need to look at the management. Does the management have a lot of skin in the game by owning a lot of shares? Or at least 5 years of annual statements converted into shares? Those kinds of things are all very important in quality investing. And dividend investing, it's important to invest in high quality because these companies often pay dividends where you need to invest in high quality because these companies often pay dividends, but many of those companies are no longer growing. So they pay out a portion of their earned income as dividends. So yes, that's not always a guarantee for the long-term success. So you have to be very critical of companies that are not only very strong, not only paying dividends, but also consistently growing those dividends. In the case of Ingredients, we see here, for example, that the number of years of consecutive dividend growth, 0. So something probably happened that interrupted this streak. But we do see that they have been paying dividends for 20 years in a row. Well, that's a positive thing. Well, here you can investigate. When has a streak of dividend growth been interrupted? You can see that they are paying out just a little bit more in dividends each time. So some good research is needed here. But we actually see that the dividend in 2024 is on track. So basically the same as in 2025. So actually the streak was broken in the past year, but in those other years before, we also see similar numbers. And yet we do see that gradually from 2014 as an example up to 2025, the dividend does increase step by step. So there is some dividend growth. It's just not very noticeable in this metric. In 2025, the dividend does increase gradually. So there is some dividend growth, but you don't see it quickly in this metric. That's why you need to take a look at the dividend. So this is a very simple way to look at it. Well, is it interesting now? Wow, this is still in the short term, 6 to 12 months. Another tool I use for that to see, okay, what could it be? Just purely for inspiration for the next 3 years, for example. That's Flask Krebs. Flask Krebs is very useful. Very useful for dividend companies that have been paying dividends for a long time. Why? Because Fastcrafts is mainly fed by historical data. New companies, just with the IPO, they don't have historical data, at least not on the stock market. So yeah, then Fastcrafts doesn't work. But Fastcrafts works really well in my personal experience. I personally find that from my experiences on companies with a long stock market history, and we happen to see that Ingredion. Fortunately, I chose a good stock as an example because that goes back to 2003. This is super interesting because it's actually a brief summary of the story. Is that this price, the black line, as long as it is under the blue, white, or the orange line is, then it could possibly be undervalued in the short term. But you actually always want to look at the orange line. Let's take a look at the next 7 years. You should also zoom in a bit on 7 or 5 years, because then you have more recent statistics, what the model is based on. And the figures that the model is based on are the earnings per share. Well, if you zoom in on 7 years, you suddenly see a difference. The blue line is the norm. Multiple. This is actually what the market is willing to pay on average over the past 7 years. And we see the fair value line. That's actually what Warren Buffett would describe as intrinsic value. However, this model always assumes, based on a price earnings ratio of 15, and the difference between this model and, for example, an experienced investor like Warren Buffett, or maybe you, is that you make your own intrinsic value calculation, and that's obviously much better. And then you might end up with, just wait a moment. This company may not have performed well over the past 7 years, but will it perform better in the coming years? Because they have applied new product innovation or new expansions, and they have improved the model. Yes, then you can use a higher multiple. So with your own research and your own thinking and creating your own forecasting and intrinsic value scenarios is, of course, still very important. But in this case, we took Ingredients, and we see here, for example, the price earnings ratio is around 13, and for next year, it's 12.5. We also see that the 5-year average of the Ingredient is higher, namely a bit higher. What does that mean for the forecasting? Well, at this moment, we see that the price earnings ratio is indeed 12.7. So this is also correct in this model. And below, we see the EPS estimates. And analysts think that it's going to rise. Well, you always need to verify this. Is this correct? Going to your insights, really that profits are going to rise. And looking ahead for the very long term is difficult. I think for the short term, then you can make a better assessment. So that's also, I think, the reason that Fast hopes to achieve this in the next 2 to 3 years. Because yes, then you have a bit more certainty for an assessment. But we often miss the mark together. So you always have to take principles like margin of safety into account. You've already established that the Ingredient pays out relatively attractive dividends for you. You also think it's a good company. And is this a good time to buy? Instead of making a decision based on technical analysis, you can just do it based on potential undervaluation. The price to earnings ratio is indeed below the fair value of 15. there is a certain profit per share. And if the profit growth is realized, then we see that Ingredion could, theoretically speaking, an average return of 17%, including dividends. That means you could potentially beat the S&P 500 with a simple dividend share. Let's stick with the normal multiple. Somehow the market says, well, I'd rather pay 13 times the normal multiple. And we actually see that it's been this way for a while, maybe one time 14. So basically, we need to stick with a lower multiple, and then we're a bit more on the safe side. And then we see that we can achieve an average return of about 10%. And of course, when we see this, then it's not interesting enough. So what does that say about Ingredion? No, just here, because anyway, it's the AL. Ingredion is not a superior company. So based on that, we want to pass for the long term. And for the short term, it does seem like a strong buy in the short term, only possibly not interesting enough. So if it's not super interesting from the first insight, then maybe you can immediately use your brain capacity for other analyses. Focus. Brain capacity for other analyses. Keep going. So then you go back to the filter list and you look at other potential lists. And this is basically what I do all day for our company in a nutshell. Well, so you can try Seeking Alpha. And we also have a discount link for fast graphs in our YouTube description. For both, we get a fee, but that doesn't cost you anything. Extras. So we get a fee, and I would really appreciate that if you want to give it a try. Indeed, Seeking Alpha costs about $250 a year. Pay with credit card or PayPal. Fast graphs costs more if you also want European stocks. In this case, I also have European stocks, so I've spent about €700 a year. Do you only want the US market? Then it's, in my opinion, 200 or €300. But in total, you're still spending 500 to 700, and that is up to €900 spent. Now, a little tip of the iceberg. We also offer analyses. If you find it interesting, the dividend stocks, and we try to look for strong dividends stocks. So mainly focused on the long term, and we do use indeed the factor analysis from Seeking Alpha. We also apply a bit of technical analysis, but only for the very short term. But much more importantly, we do in-depth fundamental research to determine if it's a good company from a strategic perspective. So it has a strong upside advantage to succeed in the long term. And of course, we mainly look at the quality factor. We also make recommendations and provide a monthly overview of top stocks that we think is an interesting option. And we do that for just €99 per year. So you can always give it a try with us to see if you like it. Or if you say, well, I prefer to do it all myself and invest the time, then it takes a lot of time. But then you also have more extensive futures by using a stock screener, like Seeking Alpha, for example, or maybe even Fast Crafts. It's up to you. With us, you get it for €99 per year, and you can try it out for 14 days. 100% that you get your money back if you don't want to stay. What does that look like? You click on sign up, start trial period. You join our community. It looks like this. You'll get to see the very first analyses, value, growth, dividend stocks. We also provide buy and sell signals. If we share stocks like ETFs, and we have countless courses that you can follow. By the way, all of this is also available for a relatively low price. If you have any questions, you'll find the channels for the community here. If you have questions about stocks, then you go to the Andeal community, you ask your question, and that's how we help you further with a bit of online guidance. What's also included in this video, CAD, of course, that's about finding the potentially best dividend stocks. You probably have never heard of this before, and it's really about the combination of these two programs, Seeking Alpha and Fast Crafts. There might also be other programs that you can use. But personally, I have very good experiences with the quant dividend stocks. And this is a very simple list, is filtered every time. And in this case, I personally bought VICI properties. That's been really high for a while. But my first positions were a few months ago. And luckily, it still remains high. But well, this doesn't really say anything. You also look based on other valuations. And of course, creating your own insights. And let's say scenarios for the intrinsic value, insights. And let's say scenarios for the intrinsic value, because basically we don't want to lose money. And investing in dividend stocks is by definition a bit lower risk than, for example, the high risk growth stocks. In my portfolio, I started at 23 with a lot of growth stocks, taking way too much risk. If I look back and I could give myself advice, I would just start with much lower risk, let my assets generate returns, and in the meantime, learn a lot more about stocks. because it's super interesting. But I now have so much wealth that I really don't need to take too much risk anymore. So I will also increasingly still a bit of dividend stocks, maybe include it. But I say it with an emphasis, maybe because by definition, I actually just want to primarily invest in growth companies. And I actually think it's but nothing that they pay out a part of their money as dividends. You should really only pay out the money as dividends if you can't find a better way to reallocate your money for your shareholders. But ideally, you just want the company to take all its profits and reinvest them back into the business. If you can't find a better way to reallocate your money for your shareholders, but ideally, you just want the company to take all its profits and reinvest them back into the business, because as we see here, you get the return on equity and the return on capital. If they are super high, let's say structurally above 15% per year, and you find that with great companies, let's take Alpha for convenience, for example. Alpha, of course, known from Google. We see that, here, return on equity, 32%, but the 5-year average is 25%, and the return on total capital is 16%. And probably over the past 10 years, that's also around 15%. Actually, very weakly taken. Does this mean that if you buy Alpha at fair value, so around the fair value, then your return would simply be 15% per year. And that 15% is going to compound every time. So you get 15% of 15% of 15%. And that's how you create financial growth. And that's how you become financially free. So I prefer that we invest in great stocks and that they simply reinvest dividends into their earning model. But sometimes you just have companies that pay out high dividends and seem to be somewhat undervalued. Yes, that can also happen, turn out wrong, but that's of course a personal choice. And that's entirely up to you. Thank you for watching. I would really appreciate it if you could subscribe to us. And if you want to like the video, if this helped you, you didn't like it at all, that's good too. You can also give a thumbs down. I don't mind. You should do everything because you stand behind it. But in any case, I want to thank you for your time. I hope this has helped you. And if you have any questions, let me know. Then I'm happy to help you further. And I would say until next time.